Okay, so just as an insurance company doesn't want to put all of its eggs in one basket, it doesn't want to put all of its money on insuring one client, because that would concentrate all its risk on one person. So investors typically don't want to concentrate all of their investments in one asset. So now we're going to go ahead and talk about the topic of diversification. So diversification means taking a certain amount of money and spreading it over multiple investments. This takes advantage of the law of large numbers, or the law of averages. So if you went and spread your money over different stocks in the stock market, you would see that, of course, some of the time Ford might have a good year and Apple might have a bad year, and sometimes it would be the other way around. And if you spread it over more and more companies, then the likelihood that all of the companies that you invested in had a bad year all at once would go down, because it would take an incredible coincidence for individual bad things to happen to all of those companies all at once. So we now want to start thinking about two different types of risks that affect firms. What are sometimes called firm-specific risks, and these are the independent risks. So statistically speaking, they're independent or uncorrelated. Another word that gets used here is idiosyncratic. Something that is an idiosyncrasy of a person is something that is unique to them. Okay, so these are sometimes called idiosyncratic risks, because they are unique to the firms that we're looking at. But then there's a second category of risks out there, and these are risks that affect the whole market. So these are dependent risks or correlated risks. Or, instead of being idiosyncratic and unique to the individual, firm or person or whatever it is out there, these are sometimes called aggregate risks. So aggregate is everything combined. So an example would be, Steve Jobs dies. That's a firm-specific risk. It is unique to Apple. It mostly affects Apple. It doesn't really do much to the utility sector of the economy or the automotive sector or the healthcare sector or anything like that. On the other hand, the whole entire economy goes into recession. That probably is going to affect all firms simultaneously. So, the thing to notice here is, by spreading your money over more firms, by diversifying, you can protect yourself against firm-specific risk. Because, again, the likelihood that bad things are going to happen to all those firms all at once is pretty low. Probably half of the firms are going to have good things happen to them, unexpected good luck, and half of them are going to have unexpected bad luck. But spreading your eggs over more than one basket doesn't protect you against the whole truck going off the cliff. That's market risk. If the whole U.S. economy goes off the risk, it isn't that helpful to have your money spread over lots of different firms. It doesn't hurt you, but it doesn't help you that much either. So a drawing that we often produce here to illustrate this concept to people is we want to think about what happens to the level of risk in a portfolio, and we would measure that by something like the variance or the standard deviation of the rate of return. How much does the rate of return swing around its average? And the number of stocks in a portfolio. And what we see, of course, is that if you only have one stock in your portfolio, you're really high risk. If you add a second stock to your portfolio, you're going to reduce your risk by a significant amount here. Add a third one, and so on and so forth. And so as you add more and more stocks to your portfolio, you reduce your level of risk. But there's still that risk that the whole truck goes off the cliff, and having your eggs over more than one basket doesn't help on that. So, this level of risk that cannot be diversified away is called our market risk. So, because it's a risk that the whole stock market is exposed to. And this fraction of it that we can diversify away, that's our firm-specific risk. So, that's one version of it. There is a slight complication, though, because not all firms are equally exposed to market risk. So, this gets into the concept of what's called beta. So some firms are much more sensitive to the state of the general economy than others. So if we had a firm, say for instance, that's producing toilet paper, hopefully toilet paper is one of the last things that we all cut back on if we lose our job. Okay? So a firm that produces toilet paper is not going to suffer as much when the economy goes into recession, nor is it going to benefit as much if the economy really does well, because most of us aren't going to suddenly start using a whole lot more toilet paper if we get that dream job. So, a firm that produces toilet paper might fall by half as much when market is down, and rise by half as much when the market is up. In which case, this fancy B here is called a beta. It's got this little tail here. This firm would have a beta of 0.5. If this had been 1/3 and 1/3, then it would have been 0.333, et cetera, et cetera, et cetera. So this beta measures how a firm moves when the whole rest of the market moves. Or put differently, beta measures the sensitivity of a firm to market risk. So a low beta stock is sometimes called a defensive stock, and you can see why that would be, because you're reducing your level of risk if you're putting your money into a low beta stock, because when the market falls, it doesn't fall as much. At the other end of the spectrum, we might have a car maker. And when the economy is doing badly, people cut back on their purchases of new cars by a lot. And when the economy is doing well, people increase their spending on new cars by a lot. So it might, say, for instance, fall by twice as much when the market as a whole falls on average, or it might rise by twice as much when the market on the whole rises. So in that case, this firm might have a beta of 2, and these are sometimes called cyclical stocks, because they go up and down along with the business cycle in a very exaggerated manner. So this idea that you can't diversify away from market risk is really a statement that if you hold the completely average representative portfolio, you hold a little bit of everything out there, effectively that's the same as saying the average stock has a beta of 1, because the average stock does whatever the stock market average does on average.